Hello, beautiful people, and welcome to another brand new edition of the ITU Forex class. In this week's episode, we're going to be talking about the best Forex indicators in the market, okay? So, the best indicators for Forex trading. Now, the indicators which we're going to be talking about are more or less kind of like a category of technical indicators, okay? Because in the Forex markets, there are indicators which are categorized as trend indicators, and there are also a category of indicators which are known as the oscillators. So basically, the trend indicators, they help you to identify when there's a trend in the market. And for the oscillators, more often than not, they help you to identify when there's a strength in a particular movement or a particular trend that there is in the market, okay? So before we dive into it, I would like us to do a quick refresher of what a trend is in the market, because before we can categorize one of the best indicators for Forex trading as being formed under the category of trend indicators, we actually need to understand what a trend is, right? So let's do that, okay? So first things first. In the Forex markets, okay, price can basically do one of three things, okay? So it's either price is, the first one is, it's either price is moving in a trend. And when it's moving in a trend, we've talked about, we've done a couple of classes, a lot of classes about market structure. And so when price is moving in a trend, it's usually going to be making higher highs and higher lows, higher highs and higher lows. And it's going to be moving predominantly in one direction. So if the market is, for example, if the market is in an uptrend, then price is going to be forming higher highs and higher lows, higher highs and higher lows continually. And that price movement is going to move from a low price point to a high price point over time, okay? If price, on the other hand, is in a downtrending market, then more often than not, what is usually going to happen is you're going to see price is not going to move down in a straight line, okay? Because usually in the financial markets, however strong a trend is, price does not move either up or down in a straight line, okay? These, you can see that this is the daily time frame of the GBP JPY currency pair. And price has been steadily moving up, down, up, down. It's been in an uptrend. It's been making higher highs and higher lows and gradually moving to the upside. Now, I know you might see a move like this and assume that, okay, I just said that price doesn't move in a straight line. So why did price move like this? This is not the norm. This is usually kind of like the exception, because you can see that even though price moved like this from this highest price to all the way down here, it actually didn't continue moving, forever. There came a point in time where price had to hit a support level, and then it reversed from this low. Okay, so the usual way you are going to see price is going to be moving in the market is it's going to be either forming higher highs and higher lows during an uptrend, or lower lows and lower highs during a downtrend. Now, this is one of the phases that the market can exist in, which is the trending phase. There's another phase, and that other phase is when you have a ranging market. So number one is when the market is trending, okay? Trending. Number two is when the market is ranging, okay? Now, when a market is ranging, price is not necessarily moving like a trending market, because more often than not, what you're usually going to see is price will be bouncing in between levels of horizontal support and resistance. It's not making higher highs and higher lows, and it's not making lower lows and lower highs. It's basically kind of bouncing up and down, within a level of horizontal support and resistance. It could be a level, but more often than not, it's usually not, one price level where price just comes there and it just turns around from that point. It's more like an area, a zone, okay, where price respects, okay. And the third is when price is consolidating. So price is only usually going to exist in one of these three phases, okay. So when price is trending, it's going to be forming higher highs and higher lows, just like I showed you here. When price is trending, that's if price is trending to the upside. If price is trending to the downside, usually what you're going to find is price is going to be forming lower lows and lower highs. And if price is not trending, but it's ranging, then it's usually going to be bouncing in between levels of horizontal support and resistance. Those levels are usually not just, a static price level where if price just comes there, it just bounces. More often than not, it's usually kind of like a zone. So an area where price comes there and gets rejected. when price is ranging, it's usually going to exhibit that kind of behavior. And last but not the least, which is consolidation, is when the volume in the market is so low that not only is price finding it difficult to form higher highs and higher lows, like when we have a trending market, an uptrending market, or lower lows and lower highs when we have a downtrending market, or even ranging, making equal lows and equal highs, or trying to make equal lows and equal highs because there's a ranging price action in the market. But rather, price is consolidating. So when it's consolidating, because of the lack of volume in the market, usually price is going to start forming something that looks like a triangle. So instead of price making sustained higher highs and higher lows, or lower lows and lower highs, because there's so little volume in the market, price is going to be consolidating. And so you're going to see that continually the lows and the highs are constricting, which is telling you that there's very low volume in the market, and in the future it's most likely that price is going to break out either up or down and continue and start forming a trend. Okay, so why did I go on this tangent? I know this particular class is about trading with the best Forex indicators in the market. So why did I go off on this tangent and explain to you the three phases that the market can exist in? Whether it be the trending phase, which is further broken down into an uptrending market or a downtrending market, or a ranging phase where price is usually going to be bouncing off of the horizontal levels of support and resistance or zones, or the consolidating phase where there's so little volume in the market that price basically starts forming triangles. Why did I take this tangent? It's because you need to understand that however many thousands or hundreds or whatever, however many the number is of trading strategies that are out there, more often than not, what you're usually going to find is that they are designed to take advantage of one of these type of conditions that exists in the market. So regardless of the trading strategy that you're using, usually it's either your trading strategy was designed to take advantage of a trend when there's a trend in the market. And you need to understand this, because when there's a trend in the market and you're trading with a trend trading strategy, then usually, more often than not, you're going to find that your trading strategy is going to perform much better or give you much more profit when it was designed to take advantage of a trending market and there's actually a trend in the market. But if your trading strategy was designed to take advantage of a trending market and the market is not trending, rather it's either stuck in a trading range or it's consolidating because there's so little volume in the market, then you're going to take a lot of losing trades with your trend trading strategy, because if price doesn't start forming those higher highs and higher lows or lower lows and lower highs, then the trades that you're going to take are going to find it difficult to hit their profit target or even move move further in your favor to give you those profits that you so crave. Okay? And on the other hand, if your trading strategy was designed to take advantage of ranging markets, so let's say you're trading with a support and resistance trading strategy, because the idea is your trading strategy is anticipating that even though trend trading strategies make a huge amount of money, the markets usually only trends for like 20 or 30% of the time. The other number of the time, the market is usually either ranging or it's consolidating. So if you decide that, okay, for this particular reason, you feel you are much more in tune with trading the Forex market with a ranging trading strategy, then you find yourself a support and resistance strategy that aims to short the market when price reaches resistance, because you are anticipating that price is going to respect that resistance and reverse against it, okay? Or price is going to respect the support level when it reaches it, and then it's going to reverse and move to the upside. Then when the market is ranging, your trading strategy is going to pick very good trades for you. Because usually, if the market is ranging, the idea is it's going to be a little bit difficult for price to break above the resistance area. Because if it does that, then it's no longer ranging. It's usually going to start forming either higher highs and higher lows or lower lows and lower highs, because that might just be the beginning of a trend. But if the market is truly ranging or consolidating, or let me just say ranging, then it's usually going to bounce off of that level of previous resistance, and then it's going to go down. So if your strategy was designed to take advantage of this, when you short when price reaches a resistance or go long when price hits a support level, then you are going to get most of your winning trades when the market is ranging. But if the market is not ranging, then when you take those trades, Your stop losses are usually going to get hit much further, much more if the market happens to start trending, because there's going to be a breakout, and that breakout is going to make your stop loss, get hit by price action. And so if the market is ranging and you're trading with a ranging trading strategy, then you're going to get the most winning trades or most amount of profits from the trades you take. But if the market is not ranging or it's trending, when you're using a ranging trading strategy, then you're going to take more losses, because your trading strategy was not designed to take advantage of that particular condition, market condition. Same goes for a ranging, for a consolidation trading strategy. A consolidation trading strategy, most of the times you find that traders who use them, they use them in such a way that they wait for breakouts. Because when there's consolidation, this is telling you that there's very little volume in the market, and little amount of volume in the market does not last forever. More often than not, the more the market is quiet, the more that is a signal that there's going to likely be a breakout in either direction. So the way professional traders usually use this type of consolidation to their advantage is by waiting for price to make a breakout, and then they take a trade in the direction of the breakout and aim to hop on the trend early to capitalize on it. So if your trading strategy is designed to take advantage of these situations, but then the market is either ranging or it's trending, then you're going to find it extremely difficult to get profits from your trades you take, because the market is not doing what it was designed to exploit. Okay? So any trading strategy that you're going to be using, regardless of what the indicators or the combo of indicators you're going to be using, you need to understand what type of market condition it was designed to exploit. If it's a trend trading strategy and it was designed to exploit trending market situations, then when the market is trending, you can expect to get good profits from it, because that's the market that's the condition that the strategy was designed to exploit. But if the strategy is a ranging trading strategy and the market is trending, then if you start taking a lot of losses, you should actually know why that's the case. It's not because your indicator is not working well, or it's because the indicator is the worst thing that's ever happened. No, it's simply because it wasn't designed to exploit such market conditions. Now, with that said, let's move on to talk about the best technical indicators, or the best indicators for Forex trading based on what we've learned now, okay? One of the best Forex trading indicators, especially for trending markets, is the moving average. Now, you've heard me say countless times that for you to be able to make money when the market is trending, you need to buy low and sell high, or sell high and buy low. Basically, when you're trading with the trend, the idea is you want to catch a trend when the market is making higher highs and higher lows. That's for an uptrending market, and lower lows and lower highs for a downtrending market. But most times, especially for complete beginners, identifying those levels of that market structure of higher highs and higher lows and lower highs, or whatever the case might be, tends to be a bit difficult, because they've got very little screen time. They've got very little experience staying in front of the charts, analyzing, watching price action and all of that. And so using moving average technical indicators helps to, simplify that. So let me quickly show you how it does that, okay? So we're going to be using two moving averages. The first one that we're going to be using is simple moving. Let's just use exponential moving, or let's use the simple moving average to keep things simple, okay? So this is the fast moving average. I'm just going to be using this one, and I'm going to be making the line a bit thick, okay? This is the 50 period simple moving average, okay? Now I'm going to add another indicator, another moving average, but this particular moving average is going to be a 200 period moving average, a simple moving average as well, but then I'm going to be adding it, and I'm going to be making it red, okay? So I think, okay, I'm supposed to show it on all time frames. I didn't do that for the other indicator. So let me quickly find the indicator list, moving averages. This is the 50. Let me show it on all time frames. Good. So I have it here, displayed here. So what does this have to do with anything? Well, if you take a close look at the chart, The way we use this is known as moving average crossover, by the way, okay? So when the black moving average, which is 50 period moving average, basically what 50 period moving average simply means is that depending on the time frame you're on, okay? So each candle that you're seeing on the chart, or if you're using a bar chart, each bar you're seeing on the chart is one period. So if you're using like the daily time frame that we're using for this particular example, when we say 50 period, this simply means that you're taking the last 50 candles, okay, that's the last 50 days, you're using it for your calculation of the moving average. So if you apply this to, let me quickly bring the settings here. If you apply it to the close price, this simply means that what the trading platform is going to do is it's going to take the last 50 candles, okay, and then it's going to be adding their close price one by one by one by one. It's going to add the last 50 candles close price, and then it will divide them by 50, because we have 50, that's the number of periods. We divide them by 50, and then the value that you're going to get is going to be applied like a dot on the chart. And then the reason why it's called the moving average is because since the candles are continually forming, as more and more price data comes and more time passes by, then this particular chart is going to be continually getting the closing price of the new candles that form. It's going to be calculating their averages continuously, and then it's going to be plotting them on the chart. So the dots that is going to be plotting on the chart is going to be connected with a line, and this is why you're seeing these lines on the chart, this black line, okay? So it's continually taking the close price of the new candle, adding them to the last 49 candles or whatever periods you have, and then dividing that number by the number of periods, and then the average it gets is going to plot them and string them with the remaining charts, okay? With the remaining values on your chart. Now, as you can see, this particular line, this black line, is showing us that over time, the closing price, the average of the closing price of this particular chart, this currency pair on the daily time frame, has actually been lower than the actual market price. So there's strength in the market, there's an uptrend. Instead of somebody who is a complete newbie to now start looking at the charts and then start going, okay, market structure, this is a higher high, this is a higher low, this is a higher high, it's going to be difficult for him to kind of identify this, okay? So because of that, you can simply use a moving average, which is just going to show you that when it's sloping to the upside and price is above it, then the direction of the trend is bullish. It's as simple as that. And if price was to be below the moving average, like we have here, you see, price here is below the moving average, the 50 or whatever, then this is telling us that the market is in a downtrend, okay? So what does this have to do with anything? Well, there's a strategy which is known as the moving average crossover strategy, where you're going to use a fast moving average and a slow moving average. The fast moving average, when it crosses above the slow moving average, that usually is a buy signal. So you can see that this particular chart, the crossover happened somewhere around here when this candle formed. So if you are taking a long trade here, you would have made a serious amount of profits, because you can see that when you got in somewhere here, okay, the market moved all the way up here, okay? So depending on your exit strategy, are you risking one to make two? Is that your risk to reward ratio? Or are you going to be waiting for the moving average line, the first one, to cross below the slow one before you close your trade? Whatever the case might be, you would have made some cool profits from this particular trading opportunity, okay? Now, what does this have to do with anything? Now, you remember when I told you that if you are using a trading strategy that is designed to exploit trending market conditions, then when the market is trending, which obviously was the case somewhere around here, from here to here, you can see that you would have made a killing in the market with your trades. But what is happening right now? What do you see on the charts right now? If I was to highlight this area for you now on the price chart, what do you see? You can see that even though the market was trending earlier on, right now at this particular moment in time, you can see that the market is actually struggling. It's not either in an uptrend or a downtrend. It's been bouncing off of levels of horizontal support and resistance, up, down, up, down, up, down. It's not clearly in a trend. And you can see that this would have been signaled by the moving average. So based on this, if you are taking a trade here, because the black moving average, which is the first one, crossed above the slow one, because you expected that price is going to be going up, then you would have taken the trade somewhere here and you would have lost money on this trade. Does this mean that the strategy doesn't work? No, it's just because you're trying to trade the market with a trending indicator during a ranging phase. You understand? So you need to understand that whatever trading strategy you're using, when the conditions, the market conditions that it was designed to exploit is present in the market, that's when you're going to be making a killing. And that's why some traders use what is known as filters. They would identify that, okay, our trading strategy is designed, or our indicator is designed to exploit when the market is trending. So what are we going to use to help us stay out of the market when the market is not trending? And our trending indicator is telling us to trade. And that's when you see traders using things like the ADX indicator, because it shows you the volatility or the momentum in the market, or other things like that, okay? So basically, I just want you to know that whatever indicator you are going to be using in the markets, you should understand what conditions it was designed to take advantage of. Again, in the same vein, this market is, at the moment, it looks like it's ranging. It's in it's experiencing ranging market conditions, because it's bouncing off of the levels of horizontal support and resistance. Now, this was our resistance area, and this was our support where price bounced off of. So if, assuming you are using a ranging market strategy, when price formed this resistance and then it moved down, when it tested this resistance area again and it failed to break above it and form this bearish engulfing candlestick, you would have taken a short trade here with your stop loss above this level. Why is our stop loss above here? It's because the idea is, if price was to break above this resistance area, then we're no longer in a ranging trading situation. It's no longer a ranging trade setup. Because for this to be a ranging market, then price needs to respect this resistance level. And so if you are taking a trade here, risking around 300 pips, or maybe you take your entry on the lower time frame so that you reduce the number of pips you're using to take this trade, and you're going for something like a 1:2 or 1:3 risk to reward ratio, price would have easily hit your profit target. And the same could be said for this again. Since it's a ranging market, when we had this support here, because price came here and it got rejected, when price revisited this area in and around here, you can see it also got rejected, because we're basically in a ranging market. So here, a ranging trading strategy would have served you well. But a trend trading strategy would not have done you as much, because the market is not trending, it's actually ranging. So what does this have to do with anything? Again, and as for consolidation trading strategies, usually they're going to be used when there's a low volume in the market, when you're trading an instrument which has very low volume in the market at the moment you're analyzing it, and then you're going to wait for a breakout to happen either in the opposite direction of that trend, of that consolidation, and then you're going to capitalize on it by taking advantage of it, because that might just be the beginning of a new trend. Okay, so this pretty much brings us to the end of this week's edition of the ITU Forex class. But as usual, before we wrap up this class, I would like to use this opportunity to actually let you guys in on our suite of bots, which are designed to trade for you and earn while you're learning. Okay, so if you're interested in learning how to trade with automated trading bots and getting them to actually trade on your behalf, identify low risk, high probability trading opportunities for you, and actually place those trades with proper risk management, as long as you follow our recommendations, then please don't hesitate to drop that in our comment section and let us know, and we would be more than happy to assist you set everything up and get you set up as quickly as possible. So once again, thank you for taking time out of your busy schedules and attending this class, and I look forward to seeing you guys in next week's edition of the ITU Forex class. Once again, thank you, and God bless you. I look forward to seeing you guys in next week's edition. Have a wonderful rest of your trading week, and cheers.